13 days can cost you $14,000 when you retire. If you leave on December 19th and your employer requires you to remain employed through December 31st for a $10,000 annual bonus and a $4,000 401k true-up, both can disappear. Retire effective January 1st instead, and you keep the money. That is not an investment forecast or a theoretical tax benefit. It is $14,000 of compensation erased because your retirement date landed on the wrong side of 13 days. Everybody spends years choosing the right retirement age. 62, 65, 67, maybe 70. Almost nobody studies the retirement month, even though your employer plan, the IRS, your health insurer, and Medicare all run on calendars that do not coordinate with one another. You think you are choosing your final day at work. The system sees a tax event, a benefits termination, a compensation cutoff, and an insurance enrollment date. I read the IRS publications, the Medicare handbook, the Social Security forms, the Department of Labor's COBRA guidance, and actual employer compensation documents filed with the Securities and Exchange Commission. The annoying conclusion is that there is no universal magic date. There is, however, a best default month, a worst default month, and a method for finding the exception that applies to you. If you want source-checked finance without the trust me bro fog, subscribe to Lazy Investor. I read the documents because apparently somebody has to. Start with the IRS calendar. Federal income tax follows the calendar year. Most individuals report income when they actually or constructively receive it, not when they emotionally feel they earned it. A bonus promised in December, but paid in February, generally belongs to the later year. A vacation payout made available in December generally belongs to the earlier year. Your retirement date matters, but the payment date on every final check matters more. That distinction destroys a common retirement assumption. People think retiring in December creates a clean break because the working year and the retirement year look separate on a wall calendar. In reality, a December departure can stack 12 months of salary, a bonus, accumulated leave, severance, commissions, and vested stock into one tax return. You may be leaving the office, but the IRS sees your fattest income year wearing a retirement hat. Move the payment into January, and the same dollars may land in a year with little earned income. The payout remains taxable. It has not vanished. It may occupy lower tax brackets because your salary is no longer filling them first. Under the federal brackets for 2026, a married couple filing jointly stays in the 12% bracket until taxable income exceeds $100,800. The next layer is taxed at 22%. If your salary has already consumed the lower brackets, a large final payout can enter at the higher marginal rate. If that payout arrives during your first low-income retirement year, more of it may fit lower down. And ignore the amount withheld on the check when judging this. Withholding is a deposit toward your tax bill, not the final tax calculation. Employers often treat bonuses and accumulated leave as supplemental wages. A check can look heavily taxed even when part of that withholding later returns as a refund, or look generous when the withholding turns out to be inadequate. A low-income year also creates planning capacity. IRS Revenue Procedure 2025-32 sets the 2026 0% long-term capital gains ceiling at $98,900 of taxable income for a married couple filing jointly. That can let you sell appreciated investments while paying no federal tax on some of the long-term gain. You can also convert traditional retirement money into a Roth account during a lower income year. The conversion is generally ordinary taxable income, so Roth conversions and capital gain harvesting compete for the same space. You do not get an unlimited zero tax buffet. You get a measured tax window, and a January retirement usually gives you more of it than an October retirement. There is another temporary wrinkle for people age 65 or older. From 2025 through 2028, an eligible person can receive an enhanced senior deduction of up to $6,000, or $12,000 for a qualifying married couple. It begins phasing out when modified adjusted gross income exceeds $75,000 for a single filer, or $150,000 on a joint return. A final bonus or leave payout can therefore raise taxable income while also reducing a deduction. Now look at the employer calendar, because this is where money vanishes without appearing on a tax projection. The Department of Labor makes the basic point clear. Employer contributions and vesting rights come from the written retirement plan. I found 401k plan documents that condition a year-end matching contribution on being employed on the last day of the plan year. I also found bonus plans requiring active employment on the payment date, sometimes as late as March 15th of the following year. In those plans, completing the performance year is not enough. You can do the work, hit the target, retire before payday, and receive nothing. Your employer may use a true-up because regular matching formulas can shortchange employees who front-load their 401k contributions. The year-end true-up corrects the match after total annual compensation and contributions are known. Some plans pay it regardless of employment status, others require you to be there on the final day. The answer is inside the plan document, not in a motivational email from Human Resources. The same problem appears with restricted stock, profit sharing, retention awards, pension service credits, and retiree medical benefits. One benefit may vest on December 31st. Another may require active employment when payment occurs in February. A pension formula may recognize only completed service periods. Your unused vacation may be paid automatically, forfeited under the policy where legally allowed, or handled under state law. The word retirement does not override those conditions. You need the summary plan description for your retirement account, the written bonus policy, the equity award agreement, the pension estimate if you have one, and the health plan's coverage termination rule. Ask payroll when each final payment becomes available to you and which year will appear on the Form W-2. Ask the plan administrator whether retirement receives any special treatment that an ordinary resignation does not. Get the answers in writing. A friendly representative saying, "You should be fine," is not a plan term. I also have multiple hundreds of thousands of dollars invested, so I am not interested in building decisions on office folklore. Health insurance creates the third calendar, and this one can punish an error before the tax bill even arrives. Your employer coverage might end on your final working day, at the end of that month, or after a stated continuation period. There is no safe assumption. The Department of Labor's COBRA guidance explicitly contemplates coverage ending on the employment date or later, depending on the plan. You need the exact termination date, including coverage for your spouse and dependents. If you are using a marketplace plan after retirement, losing job-based coverage creates a special enrollment period. Healthcare.gov generally allows you to choose a plan during the 60 days before your employer coverage ends, or the 60 days after. When you arrange it before the loss, the new plan can begin on the first day of the month after the old coverage ends. That monthly start rule is why retiring in the middle of a month can become awkward. Suppose your employer coverage stops on your final day, rather than continuing to month end. Your marketplace policy may not begin until the first day of the next month. You now need COBRA, another qualifying plan, or a deliberately arranged bridge for the uncovered days. COBRA gives many former employees at least 60 days to elect continuation coverage, and the coverage can generally be retroactive to the date the employer plan ended when you elect and pay on time. That is useful, but it is not free insurance while you wait. You usually pay the employee share, the employer share, and potentially a 2% administrative fee. If you need the coverage, the retroactive premium can arrive as one large bill. Changing plans can create a second cost through the deductible. If you have already paid thousands toward your employer plan's deductible and out-of-pocket limit, a new insurer may start you at zero unless it offers a credit. Retiring after a major medical event in September could mean abandoning a deductible you have already satisfied and beginning another one with only a few months left in the year. For an early retiree under age 65, income and insurance are now tied together more tightly. The temporary expansion of marketplace premium tax credits ended after 2025. For 2026, eligibility generally returns to a household income ceiling of 400% of the applicable poverty guideline. For coverage in the 48 contiguous states and the District of Columbia, that ceiling is approximately $62,600 for one person and $84,600 for a household of two. Go above the applicable ceiling, and the premium tax credit can disappear. Alaska and Hawaii use different figures. That means a late year retirement can create an ugly combination. Most of your annual salary is already on the tax return. Your final compensation adds more income, and the same income can eliminate health insurance assistance. A Roth conversion that looks clever in isolation can also increase marketplace income. This is why tax planning and health insurance cannot be done in separate spreadsheets by people who never speak to each other. At age 65, the rules change again. If you delayed Medicare Part B because you or your spouse had qualifying coverage from current employment, Medicare generally gives you an 8-month special enrollment period after the employment or coverage ends, whichever happens first. But waiting 8 months does not mean coverage will reach backward to erase a medical gap. Part B usually begins after you enroll, so the application should be coordinated before the employer plan ends. COBRA is especially dangerous here because it is not treated as coverage based on current employment for the Part B special enrollment period. Moving from active employer coverage to COBRA does not safely restart your Medicare enrollment clock. You can have COBRA and still create a Part B penalty or gap if you misunderstand the deadline. Then there's the HSA trap. Medicare's official working past 65 guidance tells you and your employer to stop HSA contributions 6 months before you retire or apply for Social Security if you are enrolling in Medicare after 65. Premium-free Part A can begin retroactively for as much as 6 months, but not before the month you turn 65. Contributions covering those retroactive Medicare months can become excess contributions. This catches careful savers because payroll keeps functioning normally. You are still covered by a high deductible employer plan. Contributions keep entering the HSA, and then Medicare Part A reaches backward across the calendar. The contribution was legal when payroll made it based on what everyone thought was happening. Retroactive coverage changes the result. The fourth calendar is Medicare's income look-back. The 2026 Medicare and You Handbook says the standard Part B premium is $202.90 per month. Medicare uses modified adjusted gross income from 2 years earlier to decide whether the income-related surcharge, called IRMAA, applies. For 2026 premiums, the first IRMAA threshold begins above $109,000 for an individual, or $218,000 for a married couple filing jointly, based on the 2024 return. Crossing that first threshold raises Part B to $284.10 per person per month. It also adds $14.50 per person to the monthly Part D cost. For 2 spouses on Medicare, that first step is roughly $2,300 of additional annual premiums. Higher brackets cost considerably more. A bonus, stock vest, Roth conversion, or capital gain can push income across one of these steps even if the excess is small. Retirement does give you a defense. Work stoppage and work reduction are qualifying life-changing events. Form SSA-44 lets you ask Social Security to use a more recent estimate of lower income instead of the older return. You need evidence of the work change and a credible income estimate. So, the 2-year look-back is not an automatic sentence, but it is paperwork you must initiate. Medicare does not observe your retirement party and update the premium out of courtesy. Now put those 4 calendars against the 12 months. January is the strongest default. A retirement effective January 1st can keep you employed through December 31st, which may preserve a year-end match, service credit, or vesting event. The new tax year begins with no regular salary, and replacement insurance can be scheduled for the first day of the year. Your employer plan's deductible and the new plan's deductible also begin near the same point, reducing the chance that you pay deeply into 2 annual cost-sharing systems. January still loses if your annual bonus requires active employment on a February or March payment date. It can also fail if a pension increase or equity award vests later. January wins the general tax contest, not every private contract. February can be attractive when your employer pays annual incentives in January. You collect the benefit, work only a small part of the new tax year, and still preserve most of your lower income planning window. Confirm that giving notice before the payment date does not make you ineligible. Some policies define an employee under notice as no longer actively eligible, even while the person is still receiving a paycheck. March is the bonus month. Many incentive plans pay during the first quarter, and several of the plan documents I examined set a deadline around March 15th. If a meaningful bonus requires you to remain employed until payment, retiring the following day can beat January despite adding a few months of salary. The mistake is treating a bonus you have mentally earned as money you legally own before the plan says it is earned. April contains a separate retirement account trap. If you delayed your first required minimum distribution until April 1st of the following year, the second distribution is still generally due by December 31st of that same year. You can end up taking 2 required distributions in 1 tax year, raising taxable income and possibly triggering IRMAA. Delaying the first payment is optional, not automatically beneficial. May is where deductible waste becomes more relevant. You have paid premiums and possibly medical costs into an employer plan for several months. If you switch plans, ask whether any deductible or out-of-pocket credit transfers. If it does not, include the abandoned progress as a retirement cost rather than pretending it is sunk money that does not count. June looks emotionally tidy because it ends the first half of the year. The IRS offers no prize for symmetry. By then, half a year of salary may already be competing with Roth conversions, investment gains, the enhanced senior deduction, and marketplace premium credits. If your intended Medicare enrollment is in December and you are past 65, June may instead matter as the point when HSA contributions need to stop. July often gives you the worst parts of 2 insurance years inside 1 calendar year. You can accumulate 6 months of cost sharing in the employer plan, switch in summer, and begin again under the replacement plan. July can still be correct for teachers, government employees, and people whose pension or contract follows a fiscal or academic year. Their employer calendar may matter more than the ordinary calendar year. August rarely creates a federal tax advantage by itself. Its value usually comes from a private milestone: completing a service year, satisfying a pension rule, reaching an equity vesting date, or covering a planned medical procedure under the employer plan. If none of those exist, August is often an emotional date disguised as a financial one. September is when late year inertia begins. You have earned most of the year's salary, and year-end compensation is close enough to investigate, but still far enough away to forfeit. If you retire here, compare the net value of 3 more months of work with the bonus, match, insurance, and pension rights those months purchase. Compare net value, not salary alone. October can be a strong exception after an expensive medical year. If you have met your deductible or out-of-pocket maximum and expect more treatment, remaining on the employer plan through December may save more than an early tax window. This is also when you should know the following year's insurance premiums and plan terms rather than estimating them from old figures. November is usually a waiting month. Year-end vesting is near, annual compensation is mostly earned, and leaving can sacrifice benefits that require only a few more weeks. It can make sense when a pension date has passed and the cost of remaining employed is larger than anything left to collect, but the burden of proof is now on the early exit. December is the worst default month. You have filled the tax return with almost a full year of salary. You may trigger a taxable payout before year end, and you can still lose a match or bonus by departing before the required date. Your insurance transition also lands around holidays, reduced office staffing, and the start of new annual deductibles. You absorb the complexity of retirement without receiving the clean, low-income year that arrives a few days later. Yet, December contains one useful move. Stay employed through the last required date, then make retirement effective January 1st. That separates your final day worked from your formal retirement date. Payroll, the retirement plan, and the insurance plan may define those dates differently, so every administrator must confirm how the arrangement is treated. This is the part standard retirement advice routinely misses. A retirement calculator asks your age, portfolio balance, Social Security estimate, spending, and life expectancy. It does not ask whether your bonus vests on March 15th, whether your 401k true-up requires employment on December 31st, whether your health plan ends on your final day, or whether a Roth conversion will eliminate a marketplace credit. Your Human Resources Department administers the employer's plans. It is not there to coordinate your federal tax brackets, Medicare premiums, and investment withdrawals. Your financial advisor may manage your portfolio while knowing nothing about your bonus document or insurance deductible. Nobody needs to be conspiring against you. Their incentives and job descriptions leave a gap, and you pay for whatever falls through it. Knowing these numbers and building an exit system around them are 2 different things. That is why I built a digital book called The Exit Code. It takes 50 years of actual retirement data and distills it into a mathematical framework for leaving the rat race on a specific date rather than hoping a portfolio balance means you are probably ready. It includes the $14,000 invisible bill created by the insurance gap before Medicare, the Social Security bridge strategy for delaying benefits without draining the wrong accounts, and the income framework that coordinates those decisions with taxes. There are 8 chapters of research with no filler because retirement is already complicated enough without motivational wallpaper. You can get it for less than a dinner out through the link in the description. Now bring that same date-based thinking back to the month you leave work. Use what I call the 4-calendar test. Your proposed retirement date must pass the employer calendar, the tax calendar, the insurance calendar, and the Medicare calendar. One failed calendar is enough to move the date. For the employer calendar, write down the final employment date required for every match, bonus, stock award, pension milestone, and retiree benefit. Do not combine them into one vague benefits date. For the tax calendar, list the expected payment date and taxable amount of salary, leave, severance, bonuses, investments, pension income, Social Security, and retirement account withdrawals. For the insurance calendar, place the final day of employer coverage beside the first day of Medicare, a spouse's plan, COBRA, or marketplace coverage. Add remaining deductibles and out-of-pocket exposure. For the Medicare calendar, mark Part B enrollment, the HSA contribution cutoff, the income year used for IRMAA, and whether Form SSA 44 will be needed, then price the competing dates. If January saves $8,000 in federal and state tax, but waiting until March earns a $20,000 bonus after tax, March wins. If October gives up a modest tax opportunity but saves another deductible during ongoing cancer treatment, October may win. If December offers no vesting event and no medical advantage, pushing the retirement date into January is usually the cleaner decision. The brain problem is that you naturally anchor on visible milestones. Your birthday feels real. A work anniversary feels earned. The last Friday of a month feels orderly. Tax brackets, insurance start dates, and vesting clauses are invisible, so your mind discounts them. The most expensive month can therefore feel like the most comfortable one. Set the emotion aside long enough to request 5 written answers. Ask when employment officially ends, when coverage ends, when every remaining compensation item vests and pays, how unused leave is handled, and whether retirement receives exceptions under the benefit plans. Then have a qualified tax professional model at least 2 tax years together, because moving income out of one year always moves it into another. Do this before announcing your date. Giving notice can affect bonus eligibility under some policies. And once your employer begins processing the departure, reversing it may not restore every right. Quiet research is not disloyal. It is basic due diligence on compensation you spent decades earning. If this kind of document reading saves you from one expensive assumption, subscribe. The boring line in a benefits policy is often worth more than the exciting line in a market forecast. Do not confuse optimizing the month with predicting the market. Your retirement date should not depend on whether stocks look high on a particular Tuesday. Markets can fall after any retirement month. Your control comes from entering retirement with the strongest tax window, uninterrupted insurance, collected compensation, and enough cash that the portfolio is not forced to sell on command. That is the same reason lazy strategies work. Lazy investing built more fortune than crypto memes. Good retirement timing is equally unglamorous. Read the contract, line up the dates, collect what you earned, and stop giving institutions free money because a calendar looked convenient. January is the best default month, and December is the worst, because January opens a controllable low-income year, while December piles retirement onto a nearly complete working year. The calendar does not care how long you worked. It only cares which side of midnight receives the money. Make your retirement date earn its place. Is the best default month, and December is the worst, because January opens a controllable low-income year while December piles retirement onto a nearly complete working year. The calendar does not care how long you worked. It only cares which side of midnight receives the money. Make your retirement date earn its place.